Hey, this is June from Turning Point Life Investment, and this video is for the week ending in March 7, 2009. Let's take a look at the market using SPY, starting with a 3-year weekly view. And no surprise here, we ended this week with another down week. Notice how we have 1, 2, 3, 4 consecutive down weeks. Now, from my experience, anytime you get a move of between 3 to 5 consecutive candlesticks, that usually sets up for a high probability that we're going to get some kind of counter move pretty soon. Now, what I mean by that is, since we've been down for so long, we've been pretty stretched out. You can see how we're very stretched out from this 20-day moving average, very similar to what we had here back in November. The market came back and relieved itself from this extreme condition by coming back and tagging this 20-day moving average. I would expect this move to be pretty similar, where we are getting very stretched out, and the market needs to come back and retest the 20-day moving average before moving lower. Now, can it continue to drop? Absolutely. Okay, but the chances of it going higher, or the chances of a market rally, is much higher than the market continuing lower. It's all about probability here. Okay, as far as stochastic on a weekly view, not a whole lot other than we're starting to approach oversold, but both of the lines is not under 20 yet. I mentioned last week that the MACD is most likely going to show some kind of divergence, and it's actually making itself apparent right now. We have a new low with the market as seen here, but with the MACD it's not exactly as low as this. You can see how we have one puny little bar on the red side compared to this. Okay, much weaker than what we're going to see here. So what does that mean? That means that there's going to be divergence going on in the market, and divergence usually means weakness. Okay, so that's why I keep harping on the fact that this move towards the downside is going to be more or less the last leg of our decline before we have some nice decent long-term correction. Next, we go into a 6-month daily view. All right, the first thing that will probably pop out of your head is right here. Stochastic is very oversold, and we've been pretty oversold for more or less this entire week. You can see how we are starting to get very stretched out, much like how we saw from the weekly view. And even if you look on the daily, back in November, we got pretty stretched out here. We got a nice pullback, pretty stretched out, nice pullback, very stretched out. We got a nice pullback towards the 20-day. So I would expect something similar to happen next week, where we are very stretched out, and then we ended this week on Friday with a nice doji candlestick, which is a good reversal sign that most likely next week we might come back and retest, pull back towards this 20-day moving average. Okay, we go into a 60-minute or an hourly view. Okay, once again, even on a short-term view, you can see how we are very oversold. So oversold on a short-term and a daily view, which gives you a confirming signal that the market is getting very stretched out this week. And you can even see on Thursday and Friday how the MACD is very weak, so it's very divergent. So you know that Thursday and Friday, it's pretty much the end of this entire leg down that we've been seeing these last couple of weeks. So I said, as far as pullback, look for it towards the 20-day moving average, which puts us right around this price level, around 73, 72. Okay, so that would be a good place, a good resistance level for the market to pull back towards. And if you were lucky enough to catch this afternoon rally on Friday, and you actually bought some calls, I would say this area would be a very good time to take some profit if the market heads up towards the 73, 74 level. Next, let's look at the VIX. Okay, so we all know that market head lower this week, but the VIX is not showing any sign of movement. We've been stuck more or less between the mid 50s and the lower 40s for a good month, almost month and a half. Okay, so this is telling us that there is showing some kind of divergence here, at least a bullish divergence between the VIX and the market. All right, I mentioned last time that this was very fearful. The traders are very fearful. They've never seen anything. No one's ever seen anything like this occur with our economy. But now it's different. Right now it's not fear or panic selling. It's just a slow bleed towards the downside. And that's why we're not seeing these huge spikes towards the upside with the VIX. Once again, right, divergence means weakness. Okay, so another indication that this market is getting weak towards the downside. So shorting the market, I would be a little more cautious, but start looking for potential bullish plays to go into once the market does bottom. Only question is, when is that going to happen, right? So going back to the SPY, just to recap, next week most likely we'll get a nice rally, a nice up week, back towards this 20-day moving average around the 73, 74 price level. This will relieve the market out of oversold, and and we'll see what happened the week after. But for now, let's just wait to see any failure or any weakness towards this resistance level. Then we can probably look for a new entry into shorting this market one more time towards the downside. Next, I want to go into gold real fast. Gold is probably one of the things that's still holding up as far as an uptrend is concerned, sector-wise. Now, we noticed we had some pretty decent pullback. We had a couple of nice sell-offs for this last couple of weeks. I mentioned last time that we can find potential support with the 20 and 50-day moving average, and we managed to find support with the 50-day moving average. So here's the thing. We're more or less in this transition period with gold. It seems like the uptrend is still intact, but in order for the uptrend to be healthy and alive, it needs to move above this previous high of 99. Okay, if not, if it breaks this level, then we have a new lower low, so which means that there's a new downtrend in progress. The only question is we're more or less at this point where, well, it's hard to tell if it's going to make a new high or if it's going to start rolling over towards a new low. Especially, the only reason why I say that is because it managed to come very close to its all-time high, so it potentially is setting up for a double top with gold, or at least with GLD. So what do we look for? How do we know if it's going to be a new low or if we're going to get all-time highs? A pretty obvious, pretty simple analysis to look at is, well, if we break over 100, then we know that the market for gold is still strong and that the uptrend is still intact. However, if we break underneath this low right here, then we know that we have a new downtrend in progress. If you were to draw this trend line and connect the dots here, you can see how more or less if we break this trend line, then the gold market is more or less towards the bearishness. Okay, it's no longer bullish. Also, okay, here's something that to look at is it's potentially setting up for a head and shoulder. Head and shoulders are reversal patterns. So where's the head and shoulder? You can see how this is a left shoulder. Here's the head. And right now, we're in the process of potentially making a right shoulder. Okay, so potentially, right? We don't know yet until it breaks the neckline. If you were to connect the bottoms here, and guess where that is? More or less where this trend line is as well. Alright, so you got several levels of support right here pointing towards that this is going to be a critical spot. If it breaks underneath these support lines and as well as this previous low, then we know for sure, at least with very high certainty, that gold is no longer bullish and is starting a new downtrend. And so those of you who bought gold will probably need to take some profit if that were the case. At least I know I would. Okay? So as far as gold, watch for these levels right here.